Most European millennials think investing is difficult and risky. But after building a portfolio of over 250,000 euros and being able to quit my job, I discovered a simple strategy that anyone can use to get rich. So in this video, I will show you what this simple strategy is and reveal the investing secret you need to make millions and retire early. But first, I will show you how investing the right way could make you a millionaire. Imagine you have some ice on the table. It will slowly melt, right? But if you put it in the freezer, not only will it stop melting, it will also grow. Back in the 90s, my father realized it was the same with his money. Because by keeping it in the bank, it was losing value because of inflation, meaning that it would become useless over time. So he decided to start investing. But it felt difficult and confusing. He was afraid he would lose everything. So he went to whom he thought could help him best, his bank. The advisors made him a personalized investment plan, and just like that, he started investing without effort. But this was a mistake that cost him millions over the last 30 years. But why exactly was this a mistake? Since he didn't know how to invest, he let the bank manage all his money, which sounds nice since they are professionals. But the reality is that their advice was costing him a huge annual fee of 2%, and investments were constantly underperforming the market. And the same thing will happen to you. Let's make a simple example. Investing through your bank, you normally have a return of 5% after fees. This means that 100,000 euros invested today would become 432,000 euros 30 years later, which is a lot more money. But what if I told you that by managing your own investments, you could have made over 1,300,000 euros instead? That's the huge difference between investing by yourself and letting the bank do it. Okay, now you know that it is possible to make millions if you invest the right way. But what's the right way? Imagine you're sick and you need to take a medicine. You have two options. Option 1 is a miracle pill that could instantly cure you, but it could also kill you. Option 2 is a safe pill that will take some time to cure you, but it will surely make you feel better. What would you take? I'd personally take the safe medicine. And the same is with investments. So what are the safe investments you should make? On one side, you have the miracle investments, which are speculative. This means their price depends mostly on emotions, hype, and news. Examples of these are cryptos and gold. And sure, they've had some great results and made people rich. But nobody knows how they will perform in the future because they don't produce any value, and that makes them super risky. On the other side, you have the safe investments. Those that actually produce real value and that will grow in the future because of that. And by looking at the data, you clearly see that there are two investments that have continuously outperformed the rest: real estate and the stock market. The first means buying a property, earning from renting it out, and then selling it for a higher price. The second one means buying shares of a company, receiving profit payments, called dividends, and then selling it at a higher price. But now I have a question for you. Would you rather have an investment that generates passive income with minimal effort, or one that requires a lot of your time? Because real estate needs a lot of knowledge and time to bring results. Just imagine how difficult and time-consuming it is to find the right property, maybe restructure it, and then manage the tenants. On the other hand, with the stock market, you don't have to put all this effort. And that's why you should invest in the stock market. But hey, isn't it difficult to choose which companies to buy? And isn't it risky? Well, in the past it was, and you needed to be a professional to be able to have good results. But now, it's not the case anymore. Imagine you have to find a needle in a haystack. You will never find it. So why don't you just buy the whole haystack? That's exactly the strategy Nobel Prize winners and even Warren Buffett, the greatest investor of all time, suggest. By investing in index funds like the Standard & Poor's 500, which tracks the 500 biggest companies in the United States, you get amazing results while keeping your risk very low. And the data clearly shows this. Over the last 10 years, 89% of American professionals underperformed the S&P 500. And Europeans did even worse, with 92% that lost to the index fund. So basically, nowadays there are many professionals that spend their whole days trying to find the best stocks to beat the market, but they actually lose to this simple strategy. And this is true since index funds were created. But how do you invest in these index funds? Here in Europe, we can buy ETFs, exchange traded funds, which are basically the same thing as an index fund. However, online you will mostly find recommendations for ETFs like VOO or SPY, which are for the US market. We can't buy them in Europe. Fortunately, there is an amazing website called Just ETF, which is a database with all the ETFs available in Europe. For example, this here is the iShares Core S&P 500 UCITS ETF USD ACC. I know, the name seems scary, but it is actually very simple to understand what it is, because you just click on it and you have a simple description here on the right. And this one, for example, seeks to track the S&P 500 index. And here you also have two other very important pieces of information. Firstly, the TER, Total Expense Ratio, which tells you how much these ETFs cost per year. This one is at 0.07%, which is super low, especially compared to bank fees of 2%. Then you have the dividend distribution policy, meaning how the profits of the companies are distributed to you. You can choose between two options. Accumulating, meaning the dividends are automatically reinvested in the fund. And distributing, meaning you receive the dividends as cash. Which one's better depends on you. Do you want this money to be reinvested so that it will grow faster? Or do you want to have the cash at hand? Then, if you scroll down, you can also find the most important aspect of each ETF, its performance over the years. It is always good to choose ETFs that have done well and stayed stable over time. Then you can find even more information, like the composition of the portfolio, which is always good to know. So now you know where to search ETFs, but which should you buy? Because this choice will make the difference between losing your money and becoming financially free. Think of it like going to the supermarket. You can find any type of food, but that doesn't mean everything's good for you. Some just hurt your health. But if you pay attention to what you take, you will have great ingredients for your meals. ETFs work exactly the same way. So, which are the good ETFs? Now, I can't recommend a specific portfolio, as it depends on your own personal situation. But don't worry, it is easier than you might think. As a general guideline, you need to understand the 4 main characteristics of an ETF. First, what it tracks. This defines what its composition is, meaning which companies are in it, how many, and from which countries. So the diversification and the risk of the portfolio depend on that. And the more diversified, the safer it is. Second, its performance. You want an ETF that has steadily grown over time, proving its reliability. Then you also want it to have an average return which is aligned with your objectives. Third, you want the total expense ratio to be the lowest possible, so that you have lower costs. Finally, check the issuer of the ETF. Make sure you're buying from a reliable and well-known provider like Vanguard or iShares. So now let's quickly see some real examples. One of the most common investments in Europe are the global ETFs like the Vanguard FTSE All World and the iShares Core MSCI World. As you can see, this one tracks stocks from 23 developed countries in the world, making it extremely diversified and very safe. The issuer is iShares, which is one of the most trusted providers. Here you also find the total expense ratio, which is rather low. And the performance of this ETF is also very good and stable over the last 15 years. But maybe you want something with more performance. In this case, you might choose something less diversified, such an ETF tracking the S&P 500 like the one we saw before. Being concentrated into the US means the diversification is lower, but historically this has consistently delivered great performances while maintaining the risk low over the long term. And again, the TER is very low, and the issuer is the same. But these are not the only ETFs that exist. You can find them on very different subjects. I personally like the information technology ones, but you can also find some for healthcare, others for the Japanese market, or any other sector, country or region you could imagine. So with these 4 simple criteria, you can easily find ETFs that match your needs. But now, how do you actually buy an ETF? To do that, you need a broker, which is like a supermarket for investments. In Europe, there are several good ones. I personally use Interactive Brokers. but it's more complicated. So for beginners, I would recommend trading 212 as it's much more user-friendly. So let's see together how to buy an ETF on trading 212. First thing, we copy the ticker of the ETF, which is its unique identifier. We search it in trading 212, click on it, click on buy, and choose how much we want to invest. The cool thing about trading 212 is that you can buy fractional shares. That means even if the price in this case is over 500 euros, you can still invest with just 100 euros. So I'll put 100 euros. We click there to review. We click there and the ETF is bought. It's super simple and anyone can do it. But knowing this isn't enough to actually make money through investing. Back in 2008, my father, as many other people, taken by the fear of the crisis, decided to sell all their investments, with the objective to restart investing once the market was going up again. However, because of this fear, he waited and waited until the market recovered, and so he lost a lot of money. At the same time, you'll tell me, yeah, but how do you know when it's the right time to invest? Well, you can't. And this is why having a simple investing strategy is vital if you want to be a successful investor. So how does it work? The principle is very simple, and it is backed by hundreds of research papers as the best investing strategy there is. Basically, since you cannot know when the market goes up or down, you just regularly buy without caring about it. This way, you manage to smooth the ups and the downs of the market, and even if there is a crisis, you just keep going. So in practice, you just have to make an automatic monthly payment to your investment account to invest on the same ETFs all the time. But here comes the secret every European millennial should know. Because investing without knowing this could cost you millions. This is the result of someone investing 10,000 euros for 30 years without knowing the secret. It's actually good because you have more than 5 times the initial investment. But look what happens when you know about the secret. You have more than 13 times the initial investment. So what's the secret? To understand that, there's 2 principles you need to know. First, compound interest. This is the mathematical principle behind how investments grow over time. Imagine you throw a snowball down a mountain. At first, it rolls slowly, but as it takes more snow, it grows, and the bigger it gets, the faster it rolls, to the point that it turns into an avalanche. That's exactly how compound interest works. The more your investment grows, the faster it keeps growing. Second, investment taxes. In most European countries, you only pay taxes on your investment earnings when you sell, not every year. This means your money grows faster, because it's not touched by taxes until the very end. Okay, so what's the secret? It's simple. Invest with a long-term horizon. By combining the amazing power of compound interest with this tax advantage, your money will grow faster than most people realize is even possible. Moreover, several studies have proven that historically, with a time horizon of over 20 years, the risk of investing in the stock market has always been 0. So by doing that, becoming a millionaire is not only doable, but faster than you imagined. But the truth is, if you're not able to invest a good amount of money each month, you won't see this kind of results. This is why I've made a video where I explain how you can easily manage your money so that you can allocate more to your investments and finally become financially free. And you can watch this video here.